What is up, you guys? So in this video, I'm going to be going over exactly what I did to find Skyworks Solutions and kind of why I haven't fully invested in them yet or made my position really become meaningful. And kind of giving insight as to what I do, what I'm looking for, say, growth stocks in the tech space, and what goes through my mind and what tools I like to use when observing a stock. I know a lot of you, once I made the video about how I sold out of AMD and I was, possibly switching to Skyworks Solutions, a lot of you were kind of really confused with why, like, okay, Skyworks Solutions is in a downtrend. Why are you investing in Skyworks Solutions right now? Why don't you just let AMD rip? And again, AMD hit my valuation. Whether my valuation was completely off bar or not is kind of beside the point. I, decided it was going to be worth $25 billion, and I sold that $25 billion. So hopefully, I'm not proven completely wrong, but, with future earnings releases and, whenever their 10K comes out in the next couple of earnings reports, maybe, if they're taking a massive amount of market share and the revenues are going up, maybe I'll start again. But for right now, I'm not really interested in AMD, investing in AMD right now. And so this is how I found Skyworks Solutions. Started with the stock screener FinViz, and for those of you who haven't used it, it's a great free online tool. There is a paid version of it. I don't really see any need for that. The information that you can sift through is pretty good. It has the majority of stocks, not all of them, the majority of companies that are traded on the S&P or the NASDAQ or the New York Stock Exchange are on here. There are a couple of European companies I've found that I've been interested in that are not here. But, for the majority of companies that you guys will be looking for will be on this search engine. And it's a really cool way to kind of sift through a lot of crap, especially with tech. I do think that there are a lot of tech companies that should not be either at the value that they're at, they shouldn't be trading for what they're doing, or they just are a dying company and no one should invest in them. So being able to sift through a lot of these in a timely manner really saves me a lot of work, because what I used to do is I would just look for, I would look into products that I knew were selling really well, if it was a semiconductor, and see which semiconductors in it and then how valuable they were. Or I would look at, like, okay, what are, a bunch of gamers doing? What are industries going in? Like, what are they using? And this just saves a lot of time. So to kind of go into what I actually filter for in this, for generally focused on technology growth, I want to start with the PEG ratio. I want to make sure the PEG is under 2. That's mainly to show that the company isn't really overvalued. Now, ideally, for most companies, you need a PEG under 1 for it to not to be considered overvalued. 1's fair valued, under 1 is undervalued, and over 1 is generally overvalued. But I find that with tech, I give it a little bit more of a leeway, and I give it about 1.5. And that's when I decide that it's overvalued or not. And that's because tech companies normally have a higher PE ratio. That's because they're dumping so much money into research and development that the earnings are smaller proportionally. But in all honesty, if you're in tech, you need to be dumping a lot of money into research and development. So I don't really knock any company for spending their earnings that way, especially because most tech companies don't even pay a dividend. I'd rather them actually use that money than just hold on to it into their earnings. So I start with there to see that the company is ballpark properly valued. Then I look at the earnings growth for the next 5 years and the past 5 years, and I want to ballpark them for about 10%. And that's because, the company isn't too hot, like, say, growing at 70% a year over the past couple of years, or expected to continuously grow at these absurd rates. And so that kind of gives you, that the stock is moving. The stock is definitely not a slow grower or a stalwart, but you don't have to worry about it just being extremely hyped or, so fragile that it's just going up sporadically because of some, sequence of events. That allows me to filter out stocks that are, they're moving in the right direction, but they're not getting ahead of themselves yet. And then the most important thing I would say, especially when investing in tech, but with any company really, is you want to make sure that the debt to equity ratio isn't too high. Now, this greatly differs depending on what industry you're looking at, but for tech, I like my tech to have an extremely low debt to equity, and that's because tech is so reliant on having a good economy and, a flood of earnings coming in to stay afloat. If they're riddled with debt and they're taking on more debt to produce more money even at the end of a cycle like we're in currently, the second we hit a recession, they have to be ready to sell off a lot of assets in order to just keep the doors open, lay off a lot of people, and I don't want that to happen. I like my companies to have low debt so that way no matter what happens in the economy, I can still bank on them, being profitable 5 years from now when the economy recovers. Now, the other thing you want to keep in mind is the current ratio. So current ratio, boils down to the amount of debt that they're able to pay off based off of their current assets and liabilities, and what the earnings is. So that's going to take into consideration their current assets to their total liabilities, and make sure that they have enough money to actually afford all the debt that they're taking in. And I like to have it over 1.5 because that way, even if they say lose a substantial portion of their revenue or assets and they have to sell things off, they can still afford to keep the doors open for the foreseeable future. So once you filter for all that, you get so it said 68 total results. And so as I was going through them all, I started to see a lot of semiconductor companies, because a lot of semiconductor companies are bookmarked undervalued, but it's because of cyclicality issues and people discounting it accordingly and yada yada yada. But eventually I found Skyworks Solutions, gave it a quick look, kind of went through the current PE ratio, what the forward's projected for, what the PEG is, what book value, share value, whatever. The things that really made me attractive to it were the EPS for the past 5 years, growing at almost 40%. That's great, and that was because a lot of things were getting extremely connected. Skyworks Solutions, for those of you that don't know, is really focused on radio frequencies and connecting devices to sending data between one another. So it has been a great growth. It has been in great growth the past few years, and I personally expect it to continue. But this is really interesting. It has zero debt or negligible debt. Its current ratio is over 7, so that means that the amount of money it's taking in, for the joke amount of notes that it does have payable, it has more than enough assets to cover it. It does pay a dividend, which is nice. And importantly, when you look at a dividend, you want to check the payout ratio, especially with tech. So the payout ratio right now is about 25%. So that means that 25% of the earnings that the company is taking in is, being distributed back to shareholders in the terms of dividend. And this is kind of good because while I don't really like tech companies that pay a dividend because I think it's taking away too much from research and development, this is a relatively low payout ratio. So one of two things. The company has the ability to, say, increase their dividend if they want at a pretty substantial rate over time. I prefer they didn't, but they have that ability. Say if earnings go down, they can continue to pay off that they can continue to pay that dividend even if, say, their earnings drop by half. They could still afford to pay that out. And two, they're kind of going off the same lines, is that they're not putting enough money into a dividend to take away from research and development, which I think at the end of the day is the most important thing to keep in mind with a tech company, because if you're not constantly innovating, you will get eaten alive by the market. So those are all things that I really liked, that kind of jumped out to me as far as, looking at the broad ratios of Skyworks. So then, I do a quick look up, say, Yahoo Finance, looking at the statistics, kind of see, and more things like what's matching up. So like, kind of again, Yahoo Finance has different metrics, which is why you definitely want to, for all of these free tools, you really need to be doing your own ratios because they're all going to be slightly off, and you don't want it to be right on the cusp and have it be actually portrayed lower than it actually is when you do out the math. So always make sure to double check all of these ratios by yourself. But, I go to Yahoo and I, check PEG, kind of everything that I just went through on FinViz. But more importantly, I want to check the financials at a quick glance just to see if it's worth, actually going to the company's 10K, actually making sure that all these numbers line up and see what direction it's going in. I generally like to look at the balance sheet first. That's the financial statement that I weight, above all the other ones. Next would be cash flow. And you can see that, over the past few years, the assets are growing very well for Skyworks Solutions. Their cash is also going up at a very high rate, which is great because that means that the company is pretty much ready for anything that the economy has to throw at it. Goodwill, and that is generally, through buying other companies or acquisitions or whatnot. Pretty stable. not getting too out of hand. They're, prioritizing collecting cash right now and accumulating assets than they are with just buying goodwill, which is great. So the current assets are going up great. Total assets are going up great. I generally put all of this in an Excel spreadsheet to get down the percentage growth of each one's, each year. But you can kind of just tell the trends going in the right direction. Great thing is that you see no short-term and no long-term debt, which is fabulous in my opinion. And so you look at like their total liabilities to even their current assets, and their current assets dwarf it. So that is a great sign. And then I go to the cash flow. I see that the total cash flow from operations is going up gradually. The net income is going up gradually over time. The cost of say cash flows of said cash flows is it's going up at a reasonable fast rate. So this is generally like capital expenditure and investments. So those are things that the company is it counts as a negative right now, but generally that will lead to more positives in the future. Because if you don't invest in capex, you run out of plants, you run out of workers, you run out of tech, you run out of IPs. So you definitely want to see this happening, but you don't want to have it going up at an alarming rate. And again, this is just, a quick brush through all of these. If you guys don't know what any of these terms are, make sure to look them up. I'm not really going to take the time. This video is already getting kind of long. I'm not going to take the time to go through each individual one, but Skyworks Solutions was definitely going in the right direction with all these go. So I then check most of these with, say, Morningstar. I think Morningstar is generally a better site than Yahoo Finance is as far as reliability, but Yahoo Finance, at least for me, is much easier to navigate around. And it's kind of cool that, they give like the estimates from what analysts are saying. You can check, what's projected to be the next few years. So this is kind of cool. A lot of this is what is put on FinViz. Keep that in mind. So, generally these won't have that much of a discrepancy, but you definitely want to make sure that you find the analysts and see what the analysts' like track record is that are saying like, okay, this is a buy. And then you look at the analyst and you say that, okay, the analyst has lost money over the past 3 years when the market went up. So definitely do not take analysts' recommendations or estimates at face value. Most of them are wrong, but it is nice to know that there's a positive incentive. So you go through everything, and then I'll go directly to, say, Skyworks' website. You should probably do this with every company. I don't know why you ever wouldn't. You want to go what the actual company is, what is on their website, what are they really talking about. So obviously Skyworks is really focused on 5G and connectivity. So you can look at all the markets that they've entered, you can look at the application that they have, you can look at all their individual products, and you can go in depth as much as you want on here, but the most important thing to do is you want to go to their investors relation page. And generally, a side note, if the investors section of a company's website is hard to find, that generally means that they don't have investors like in their front mind, which is something to really, kind of think about. Maybe it's not too worrying, but you want to know that companies are working for their shareholders at the end of the day, for their shareholders, but satisfy the customers. But there are a couple of sketchy companies that I've found, especially smaller cap companies, that do not even have their investor relations on their website. You have to go to a different site to even get onto it, and it's just, I don't know, it kind of turns me off, and just not something I want to see in a company. So anyways, I went down to the annual reports, check their most recent one. So you get on their annual report, you definitely want to make sure that you can check all of their numbers. You'll also read up like, hey, introduction to the shareholders. This is what the company is doing. You can read a little bit about all the executives, the CEO, what their opinion is on the company, what direction they're going in with it. And you definitely want to read, the majority of the 10K. Like obviously you can skip the generic, like any future guidance is, just future guidance and it's not actually in stone, take it with a grain of salt. All that, like obviously I just skip to that, but anything that's written by the company, if you're investing in a company, especially for the long term, you want to know everything that the company said, because, sometimes a little tiny nugget is going to be, kind of swept under the rug by the CEO, but then you realize that could blow up into a huge issue down the line. So you definitely want to go through everything, but you mainly want to use the 10K, assuming that, you've already been looking into the company. You really want to look at to make sure that their financial statement is, in the same standing as it was on, like, say, Yahoo Finance and things like that. So you can kind of go through all this, so like look at their income statement. You know, you want to make sure that the numbers are reasonably lined up, because again, Yahoo Finance is not that reliable. So yeah, everything for the most part seems to be in line. So that means that the majority of, you know, the numbers that you saw in Yahoo Finance were correct, but you definitely want to crunch out some of the numbers and make sure that the ratios are actually what the ratios are, because, you know, you can look at, say, Skyworks Solutions on, say, FinViz, PEG of 1.09, and then you go to Yahoo, and the PEG is of, you know, 0.98. So there's going to be a discrepancy. You know, you just really need to do your due diligence with the actual numbers from the company, break out the calculator or your Excel spreadsheet, and just do it over. You know, like, yeah, it's going to seem tedious, but you don't want to take, you know, Yahoo's missed input as, you know, a piece of solid investment advice and invest in a crappy company because of some bad key input. So that's kind of like the bulk of, you know, the 10K. Like, you need to read the 10K. Generally, I like to read the 10Ks of the past 5 years and just see to make sure that everything in the company sounds accordingly. You know, everything's been going in the right direction, and it's not like all of a sudden things are going great and the CEO is acting like everything's been perfect for years, you know, things like that. You want to make sure that the CEO has been pretty forthright and accurately at saying what direction the company is going in. All right, and so the last tool that I want to go over is TradingView. So TradingView is a really cool free online charting tool that, you know, can allow you to look at pretty much any company you could ever think of, commodity, currency, futures, cryptocurrency, whatever. And it allows you to do, you know, like some chart analysis that, while I don't think technical analysis is, you know, the best thing to invest with solely, I do definitely think technical analysis is very useful as a supporting metric to your investments. So if everything checks out fundamentally, I do think using technicals as a support for when you should, whether you should or shouldn't start to add shares, is a pretty good, you know, way to kind of backtest everything. I personally do believe that you can start a very small, like maybe 10% of whatever your total position is going to be immediately once you know that you love the company and you like all the ratios. But I wouldn't say go fully invested until the chart dictates that now is a good point to go long. Because, for example, like, you could have found out that, okay, everything's going great with Skyworks Solutions here, and, you know, everything was it was historically overbought. You know, it was getting some resistance. It just got rejected. Now it's back at that line again, but it didn't actually clear it. And then, what do you know, it failed, and it just isn't, it still has not actually fully recovered to that point. It kind of touched it a couple of times, but it's still not actually there. So, looking at what's going on right now in the past couple of weeks, Skyworks Solutions is just kind of bouncing on this 180 moving average line. And, you know, I do think it's going to bounce, and I do think eventually it's going to go in the upward direction. But also keep in mind that, like, right here is the high that it was rejected from, hit it once and then hasn't hit it again, and has hit, you know, about $110 a share many times and been rejected. So those are pretty substantial resistance levels. Funny thing is that if you look at, you know, this particular line, which is at like 117.71, and then you go to like what the target price is from analysts, what do you know? It's the exact same, or, you know, roughly the exact same point. So I kind of found that really funny. And, you know, if you look at the, you know, potential return to that, say, point from the analyst perspective, it's about 30%, which is great. If you're going long, doesn't really matter. You know, if you're looking to invest in a stock for, you know, 5 years at a time, you don't care about, like, say, this short-term price prediction, but, you know, definitely know that the price points that analysts are putting in definitely take technicals into consideration. And, you know, the chart is definitely in, at least for the past year or so, it's definitely in a upward trend. But you do want to be cognitive of the fact that if it breaks this line, it, say, could continue a downtrend, and it could just get really ugly, and, you know, you could be long in the company, but you'll just be losing, you know, capital in the short term for no reason, when you could have just, you know, held off and waited to enter, you know, a month or so or a couple weeks. And when you're thinking about, you know, 5 years out, waiting a couple weeks or a month doesn't really matter. So that's kind of the very quick, or I guess very rant-esque way of what I do after I, read up about a company and kind of decide I want to invest in them. What is everything I look at, and what are the tools online that I use? So I hope you guys got some use out of this. Let me know if you guys actually use these tools yourselves. Maybe you use them in a different way. I do. Is there maybe I'm using a tool that you guys think doesn't actually work, or that you've discovered has wrong data? I'd be more than happy if you share that information with me. And again, like, obviously this didn't go through the whole reason as to why I thought the industry would be going up and why I think Skyworks Solutions has a great future. But, based off of a rough fundamental and technical analysis, these are the tools I use, and that's why I think Skyworks Solutions is a great buy in the future. But I have not fully committed to it yet, because not everything is not everything is in order. So hope you guys got use out of this. I'll make sure to see you guys in the next one. Let me know if this video is a complete bust or not. Again, this is my first time doing a screen share thing. And so no, let me know what you guys think. Do you want more of these videos? Do you never want to see this horrible thing again? And yeah, hope you guys have a great day. I'll catch you in the next video. Peace.